Broadcasting from the Business RadioX studio in Alpharetta, it's time for ProfitSense with Bill McDermott.
Good morning. Welcome to ProfitSense. This podcast dives into the stories behind some of Atlanta's successful businesses and business owners and the professionals that advise them. We help local business leaders get the word out about the important work they're doing to serve their market, their community, and their profession, as well as discuss issues that business owners are facing today across a wide variety of industries. I'm your host, Bill McDermott, and this show is presented by the Profitability Coach. When business owners want to increase their profitability, they don't have the expertise to know where to start or what to do. I leverage my knowledge and relationships from 32 years as a banker to identify the hurdles getting in the way and create a plan to deliver profitability they never thought possible. We have two great guests on the show today. Grant Brim. Grant, welcome.
Thanks for having me. Glad to be here.
And Ron Bracewell, managing partner with BatesCarter. Ron, great to have you on ProfitSense.
Great to be here, Bill. Grant, good to be on with you.
Absolutely.
So, Ron, I'm going to start with you. You know, it's hard to transfer a business, and there are factors involved. So let me just kind of start out with a question. Is business easily transferred or continued? And what are some of the factors involved?
Well, I'd say the general answer is no. It's not easy to transfer.
Agreed.
And I've always worked with closely held businesses, and it has given me an appreciation of the New York Stock Exchange, the public market, how efficient that market is. That's contrasted with the market that our clients are dealing in. They have to make their own market. Yeah. And that's typically in a sales environment, but there are other ways to transfer your business. But there are challenges: time, money, finding a buyer. All of those things are challenges.
Yeah, and to try to peel that onion back maybe even a little further, if your business can be transferred, who's your most qualified buyer or successor? And also, what are the attributes that make for the best buyer or a successor?
Yeah, interestingly, your number one competitor may be your best buyer.
Ah, okay.
Because they presumably know how to do what you do, and presumably would be willing to pay the highest price for it. We've had experiences over the years where a number one competitor was a public company, and that's the real gold mine there is they want to eliminate you from the market, and they may be willing to pay that in the form of cash and stock. For an internal transfer, it's usually a key employee, and many times in our business, it's a family member. It's
Sure.
the next generation.
That makes sense. We're talking this morning with Ron Bracewell, who's a CPA with nearly 40 years experience in a variety of areas of public accounting, including audit, tax, and consulting. He's also accredited in business valuation, recognizing his substantial experience and knowledge in valuations of closely held businesses. And so, Ron, I want to kind of now shift the discussion. I'm sure there's some questions that arise when you're advising your clients on whether to sell to a third party or to transfer to a family member or successor. What are some of those common questions that get asked?
Yeah, I think the business owner has to be honest with himself or herself and to look at that key employee or potential family member that they're grooming for the next generation, and really assess whether that individual is capable of taking over the ownership role. And those are sometimes difficult but important questions to ask. And I think that's where a trusted advisor can come in and give them good, honest advice. And does that fit with their plan? Are they able to internally transfer to a family member, which might suggest a gift.
Sure.
Is that financially in the plans?
Right. I know, speaking for myself and thinking about my own business, so I have 2 daughters who are both happy in their careers. I have sons-in-law, but I don't necessarily see them transitioning into the business. And so my individual challenge might be a little different from that, but I could see how there's a lot of questions that go into that. So I'm also a baby boomer. A lot of baby boomers are looking at retiring businesses. So that kind of leads me to the question, when should a person consider transferring a business?
Yeah, I think that's obviously another component. And to digress just a moment, Bill, I would say every business has some level of value. I used to have a great analogy in saying Tiger Woods cannot sell me his golf game. It's unique to him.
Sure.
He can't transfer it.
Yeah.
But I would be willing to pay him something for a year's worth of instruction.
There you go.
And so, even in the most personal service business, without a quote unquote book, there's usually some value to transfer.
Sure.
And sometimes you have to unlock that. But as far as the timing is concerned, I think that's generally, as you say, in the baby boomer generation, you should always be thinking about growing value as you grow your company, presumably in your 30s or 40s.
Right.
And perhaps you start thinking about that exit strategy in your 50s. Don't wait until retirement to do it. That's usually the least profitable and most expensive way to exit. So it takes some time. We've had instances where we had a client a couple of years ago who was of our age and had been thinking about selling for a while. And this particular business was a hot business. Private equity was interested in them, and the multiples were great. And then we also had the threat of a tax increase.
Sure.
There was a discussion a few years ago about the capital gains rates increasing. So we had a conversation, one of a string of conversations over the years, and this particular one is now the time to pull the trigger. And all of those factors lined up to say yes. And so he did.
Yeah. And so I've heard there are kind of 3 T's in a business transaction. There's certainly taxes, timing, and terms. And so I do want to talk about steps to take ensuring a successful transfer in a moment. We're talking today with Ron Bracewell, who's managing partner with BatesCarter. BatesCarter is a full-service firm founded in 1962. They offer traditional accounting, tax and audit services, and enhanced with a range of advisory, valuation, and consulting services. And so talking about ensuring an effective transfer, a business owner only exits once. He or she wants to maximize the value of the business. So what should a business owner be doing right now to ensure an effective transfer of the business, in your opinion, Ron?
Well, I think of value as being a quantitative mathematical calculation. What's your EBITDA times the multiple, that sort of thing, your cash flow. But it's also qualitative. And so I say that every buyer arrives at the table with uncertainty.
Sure.
And your job as the seller is to reduce that uncertainty. And so how do you go about that? And the better your financial records are, the more times you can put in front of that potential buyer accurate, hopefully third-party attested financial statements, accurate tax returns, timely filed, with fully reporting everything, the more you're going to reduce the uncertainty that potential buyer has.
Sure.
And give them a better feeling about things.
Yeah, and I found, of course, the test used to be having audited financials. I think now there are possibly even some buyers that use a review, but typically there is some type of third party attestation. I always stumble over that word.
Yes.
In order for the buyer to feel comfortable about the financial statements that the numbers are based on.
Agreed. And sometimes a compilation, which is the lowest level of reporting that accountants, CPAs do, is satisfactory to the buyer. The larger the company, the more likely you are to need an audit. We have plenty of clients that have been planning for years. They know they're going to have an exit one day, and so they have a long history of audited financials for that reason. The other thing is if you know your potential buyer or buyers, your market, that may direct you as to what is typically needed. And most business owners are talking to buddies that have sold and that sort of thing. And so they have a general feeling for the market of buyers. But sometimes you don't. We've got a transaction going on now that's got a foreign buyer. Well, these people want an audit, and nothing less than that will suffice. So sometimes you have to decide what your market is.
Sure. It's understandable. A lot of times people don't want to pay for that audit. And so I know in discussions, there's always a lot of give and take over terms and requirements, which then takes us to due diligence. I know a lot of deals can fall apart during due diligence. Things are discovered. Sometimes there's confusion. But I did want to talk to, in your experience, what are the types of things that you see buyers requesting during due diligence when they're acquiring a business?
Yes, that's a long list. I think one of the areas that we see a lot of questions about tax reporting, particular multi-state, and the states. If a typical business is probably going to file in more than one state, or maybe they should be filing in more than one state.
Sure.
And a savvy buyer is not going to just accept a rep and warranty to minimize his or her risk. They're going to comb through those tax returns, and they might do a nexus study. And if they determine in their eyes that you should have filed in South Carolina and Tennessee and North Carolina, then that's going to be an issue. And that's the deal may still get done, but it may not be done quite as satisfactorily as you wanted it. So that type of thing you can address beforehand.
Sure.
You can do a nexus study. That's probably not a bad idea. Another area that we see in the tax world are different credits. For example, the recent PPP loans and the employee retention credits. While those were great and wonderful, they create uncertainty, and you have what is an extended tax audit window of 5 years instead of 3. So a buyer comes in and has some risk associated with that. So you need to make sure all of those items are resolved. And again, you communicate certainty to the buyer.
Sure. I can see how that would be important. Closing thoughts. What if someone's thinking about selling their business, and let's say 5 years out? What's generally a good place to start? What are maybe the first 2 or 3 things that business owners should do, Ron?
That's a great question. And I think the first place to start is in some sort of valuation consulting engagement. There's essentially 2 ways we produce valuations. One is with a thick report that's going to a user that, such as the IRS, who doesn't know your company, and they go from knowing nothing about your company to reading the report and understanding what it does and what its value is. A valuation consulting engagement is contrasted with that in that you're dealing with people that know the business, and you anticipate selling to somebody that is going to know the business. So you don't need the big, thick report. You just need the quantitative analysis that I talked about.
Yeah.
That's typically an income approach.
Okay.
It's cash flows discounted at a required rate of return. Said another way, it's your EBITDA, your earnings before interest, taxes, depreciation, and amortization multiplied by a multiple. You get to the same place. It's just a different way to do the math.
Sure. It all starts with a valuation, doesn't it?
It does, and what that does is give you an idea. Okay, this is where I am. That's not where I want to be. Okay,
right.
Let's go grow some cash flow.
Yeah,
and get there.
Yeah. Sometimes inertia prevails, but once you get that body that's been at rest in motion, then the goal is to stay in motion so that they can do the planning they need to do.
Absolutely.
I'm thinking there are probably some listeners that will hear this podcast that may want to get in touch with you, either with questions around their business or questions around valuation. What's the best way to reach you by phone or email? Yes.
Email is rbracewell@BatesCarter.com, and my last name is Bracewell, as in Bracewell. And phone number is 770-532-9131. And we're in Gainesville, Georgia, BatesCarter.com. You can find us pretty easily. We've been around 60 years, Bill.
Wow.
This August will be our 60th anniversary.
Wow. Congratulations. That's quite a milestone.
Thank you.
And, again, thank you for sharing your expertise, your experience, words of wisdom, things to do for business owners. Just been an invaluable visit. Thanks, Ron.
Thank you for the invite.
We're going to turn our conversation now over to Grant Brim. Grant started his own firm, Brim Law. And Grant, I just want to say first, with many businesses marketing via social media and similar platforms, what are some of the issues that they're facing that are unique to those arenas?
Sure. And I think what I've seen in the last couple of years is obviously as the internet's grown, doing business online has become more available, more accessible for everyone. But as that's sort of evolved, especially with things like TikTok and stuff like that, I have, first of all, younger people coming to me that are starting businesses or have purchased businesses or are getting into the arena. There's a couple of different issues that come up. I mean, the first one seems to be for me is that a lot of folks that I've dealt with traditionally have been in business for years, and some of the basic things that I think a lot of business people and that I sometimes will have taken for granted, they don't know, the people that are coming in. So simple things that seem simple to me may not be for somebody that's 23 years old and never been in business before. So the importance of having proper entity type and things like that, as it relates to everybody online, especially with things like TikTok, for example, is I'm seeing a lot of trademark infringement issues come up. So a company may have a logo or a slogan. These things online are getting ripped off left and right and used on the same platform by other users to make money off of that brand. And so being able to protect that properly is extremely important. And what you'll find is most of these platforms, and it goes from Amazon through to something like TikTok, for example, they typically will have a process in place in their own policies, that determine exactly how they deal with that. So if you have a third party that has that is infringing upon a logo, for example, or a slogan or something like that, you have to first, before TikTok's going to do anything about that, you've got to show that you have done your part. You've taken the proper steps to legally protect yourself as much as you can, and which typically in that situation means that you have a registered trademark protecting that logo or that slogan or whatever that is. And if you have that and you go through their process, then they have their own process typically for removing that, or in some way or another dealing with that to the greatest extent you can get that done, which is what your goal should be. I know Amazon has, for example, on sort of the same topic, and I'm not a patent attorney. I have patent attorneys that I work with, but I do sometimes run into situations with clients that already have registered patents. If you have a registered patent and somebody puts basically a product that is infringing upon that patent, Amazon has a process to pull that down. As long, again, as you've gone through those steps and done what you're supposed to do along the way.
Yeah. So kind of a follow-up question. How can businesses mitigate their liability or increase their ability to defend their brands in this arena? I know you talked a little bit about registered trademarks, but I'm sure there's some other things as well. That
is actually the most important thing, number one.
Okay.
And because what will often happen with regard to trademarks is I will get someone that has not been a client in the past that will come to me with an infringement issue, and the biggest problem that they have is that they may have a trademark, but they have never registered that trademark. And registering a trademark is not as easy as forming an LLC, for example. It can take up to a year or even longer sometimes, depending on what kind of issues come up along the way. So actually, the biggest thing they can do is to go ahead and figure out what their IP issues are out of the gate before they put their product up there, or as soon as possible, and go ahead and get those things dealt with. And this sort of, and I don't want to go off on too much of a tangent from the question that you asked, but that kind of goes into other things that are not necessarily online. I mean, it goes into things like protecting trade secrets, for example. You have, and it's extremely important if a company, for example, has a sales force, a sales team, that they are taking proper steps to protect their customer list. And there's a legal way to do that to make sure that if somebody, misappropriates that, you have a claim and you can do something about it. So that coming out of the gate to a qualified attorney to be able to counsel you on that and make sure that you've done everything you can do, because the key is you want to make sure that on your end as the business owner, you've taken every step you can take to put yourself in the best position to have that third party platform act on your behalf and remove the offending content.
Sure, I can see how important that is. We're talking this morning with Grant Brim with Brim Law. Grant is a business attorney in Roswell and the founder of Brim Law. Grant has been in practice for 15 years, starting his firm in 2011. Over the years, Grant's practice has evolved from litigating business disputes to helping prevent them in the first place, and his legal services are geared towards helping clients navigate the often treacherous legal landscape that comes with running a business. And it is treacherous for sure. I want to now switch topics a little bit. I know that some of your work is also as an outsourced in-house counsel for businesses. So why shouldn't a company simply use an employee policy manual or handbook they find online for their company, Grant?
So when if you download or if you go to Google and you search employee policy manual, you're going to find a bunch of examples. And a lot of what's in those examples is going to be great. You're going to find many provisions that you need that may not need to be changed at all. The issue comes in with the differences in individual industries and businesses. So for example, if you have let's say that you have a parking company, there are issues in that particular business that are not going to be found in, for example, a restaurant necessarily, or some other a bakery or something like that. It's going to be very, very different what they need to do, and those policies, for example, in that scenario, might relate to how do we handle vehicles, how do we handle cars, and things like that. And what I found is that if you when a company comes to me and needs a policy manual, oftentimes the process of preparing that manual with them will identify issues in their business that they need to deal with that they hadn't thought about before. It will also provide opportunities for training their employees on issues that they hadn't thought about before. And to give you an example, I had a client that had an employee go online, again, another online issue, and post live video streaming while they were working, which accidentally released some data to the public. that should not have been released. And the company was unaware of it, of course, until they got complaints, until they became aware of it. Now, that might have happened anyway, but it's less likely to happen if you have an appropriate manual in place and if there's training in place along the way to make sure that the policies are actually implemented.
Sure. And kind of a follow-on question to a handbook or policy, but in a different sect. So we've talked a little bit about social media. What steps should a company go through when implementing policies related to social media?
And I touched on a little bit in my last answer, but training. Training is key. So anything in there, unfortunately, a lot of the things that can happen in a business the consequences of them go beyond simply terminating that employee or some sort of discipline for that employee. If something is egregious enough, it can unfortunately lead to lawsuits. It can lead to losing valuable contracts or clients and things like that. So a company really needs to go through and look at their individual issues that they might face on a day-to-day basis and determine what's likely to happen here, what may happen in this scenario, and go through and make sure their employees know what those issues are and how to handle that. And that goes in addition to simply, what am I allowed to post while I'm at work? What am I allowed? What are businesses allowed to post at all? And their employees allowed to post at all? What is the email policy? These types of things, because once something's sent, it's not coming back. When something's online, it's really difficult or impossible to get it offline. So you want to make sure that the employees are trained and that the company has processes in place to deal with those types of scenarios when they do occur.
Yeah, those are great insights. Thanks for sharing those. We're talking today with Grant Brim with Brim Law. Brim Law represents businesses throughout the state of Georgia as their outsourced in-house counsel. The firm's services cover a variety of issues, including consultation and document preparation, employment relationships, vendor agreements, general contract review, asset purchases, mergers, and brand protection, just to name a few. I do want to shift the conversation a little bit to M&A. In your experience, Grant, what are the most critical items from a legal standpoint that need to be addressed in an M&A transaction?
So ideally, and oftentimes this is the case, when I get a client, either the buyer or the seller that comes in for usually an asset purchase, they're coming from a trusted referral source like a CPA or maybe a business broker or something like that, and it's usually early in the process, so we can sort of deal with everything ahead of time. However, that's not always the case, and a lot of times I get buyers or sellers, which is great. They call me after they may already have an LOI in place, a letter of intent in place, or at some point they've already gotten through the process. Some of the key issues that are often overlooked are initially is the letter of intent. I would not recommend signing a letter of intent until you have retained an attorney to help you with that, because I think there's often a misconception that when a party signs a letter of intent that this is not a binding document. And it very well might not be, but it also might be. And if you don't have an attorney help you review that and make sure that it is what you think it is and what it needs to be, then you could end up binding yourself to something that you never intended to in the first place. The other thing that comes up is a lot of folks, and this, as I said, I'm getting a lot of less experienced buyers and sellers. This happens a lot in this situation where they haven't thought about, should it be an entity purchase or should it be an asset purchase? And most of the time, it's probably should be an asset purchase. There are exceptions to that. It's possible that the selling company has contracts in place that are assets that are not transferable or assignable to another entity.
Sure.
Something like if that's a significant enough issue, for example, that might be a reason to do an entity transfer instead of an asset transfer. So there are reasons why that might not be the case, but that needs to be looked into and discussed and analyzed with the client before that decision is made. And then from there, you're looking at things like, what liens are in place, what are the tax liabilities of the selling entity and financing and things like that. So these are all things I know. I've had clients that have come to me in the past that have already done the deal and are dealing with the consequences of not dealing with these things. So things like undealt with liens or tax liabilities that weren't disclosed and weren't dealt with, the purchase contract may technically say you can go after the seller for that, but as a practical matter, that might not actually work because they may be gone. They may not have any money, things like that. So these are things you want to deal with ahead of time. That's the kind of work that I do and stuff that I help with.
Sure. That's an invaluable. And in closing, Grant, I just want to say for our listeners, what advice would you give to business owners that are getting ready for an exit?
My number one area of advice usually is, and this assumption is that they're coming to me really early. That they're coming to me and I think I might want to sell my business. My number one, what I do at that point is I typically will send them to somebody that can, a business coach or a CFO or a qualified CPA or some evaluation expert that can give them the appropriate guidance in terms of, is this business ready to sell? Because that's not really what I focus on. Now, once we get to the point where we have either a business that's ready to sell, or maybe we actually have an offer on the table, or there's a tentative acceptance of that offer, then what we're looking at is making sure that the finances are clean, making sure, let's go through the UCC filings and what do we have out there that, and for the audience that have experience with UCC liens, these are liens that are filed typically when, any kind of business finance, a commercial lending situation, there's going to be a UCC lien filed. They don't always get canceled. You could pay it off. You could take a loan out next month and pay it off in 6 months. 4 years from now, that lien may just be sitting out there that somebody forgot to cancel. You might have 20 of those. So that stuff takes time to clear up. So you want to, the biggest piece of advice I would give is get a qualified attorney in place as soon as possible to start going through these things and making sure that, okay, when we get to the closing table, we're ready to go. We don't have these issues to worry about. To the extent we do, let's go ahead and deal with them now. And so we don't have to worry about them later.
Yeah, I know as a former banker, I had the experience of, unfortunately, not terminating some UCC liens on loans that I thought were terminated, only to find out later that our loan review area legal team did not terminate those. That's an issue.
What I found too is, you'll often find if it's a big bank, it's usually not a problem. If it's a small company that is the creditor on that, you might have a real difficult time finding somebody to help you with that. And there is a statutory process that we can go through to get those things cleared off, but it takes a little bit of time. So we need to be ahead of the game for those situations.
Yeah, great point. If someone wants to get in touch with you either by phone or email, Grant, what's the best way for them to reach you?
Yes, my phone number, my office number is 678-353-3350, and my email address is gbrim, that's just my first initial G, and my last name Brim, B-R-I-M, like the brim of a hat, gbrim@brimlawfirm.com.
Grant, it's been great having you, and certainly appreciate the legal insights you've brought to our listening audience today.
Thank you for having me. I enjoyed it.
So I want to take a minute. We've reached the midpoint in the year, and you might be reflecting on the first half and are either looking to course correct or finish strong. So what are you going to start doing, stop doing, and keep doing? One of the ways to determine this is to look at key metrics of your business. You can't manage what you don't measure. Here are 3 things that you must know about key performance indicators. First, key performance indicators, or I call them KPIs, build on each other. They're derived from the metrics in your business that are created out of measurements like profitability, revenue, or number of customers. Generally, ratios and percentages make the best KPIs. So instead of looking at profitability, look at your gross or net profit margin. Second thing is KPIs become relevant when they're measured over time. So looking at your gross or net margin this year against the last 2 years can tell whether you're improving, declining, or inconsistent. And third, KPIs that a company measures will vary depending on the type of business. However, I find that most business owners are interested in 4 things. They're interested in profit, cash, leverage, and activity. Activity is how they're collecting their receivables or turning their inventory. So you can learn more about how to measure these by visiting our website, theprofitabilitycoach.net. If you're still not sure where to start or what your numbers are telling you, let's talk about a business financial checkup. If you want to keep up with the latest in pro-business news, follow us on LinkedIn and Instagram at The Profitability Coach. If you want to listen to past or future ProfitSense episodes, you can find us on ProfitSenseRadio.com. This is ProfitSense with Bill McDermott signing off. Make it a great day.